Hawaii's paradise dream just turned into a financial nightmare. Maui condo prices have plummeted over 30% in less than 18 months, wiping out billions in property values and forcing thousands of residents to make impossible choices. When Governor Josh Green finally broke his silence at yesterday's emergency press conference, his response sent shockwaves through the real estate community and revealed a crisis far deeper than anyone imagined. Behind the tropical postcards and luxury resort marketing, more than 40,000 homeowners are now underwater on their mortgages. Entire oceanfront developments sit half empty as buyers vanish and sellers slash prices by hundreds of thousands just to escape. The numbers tell a story of complete market collapse. Average monthly carrying costs have tripled since 2021, while median household incomes have barely budged. Insurance premiums that once ran $2,000 annually now demand $8,000 or more, assuming coverage can be found at all. But the real shock came when internal state documents leaked, showing the governor's office knew about the brewing disaster months before it hit the headlines. Emergency meetings, frantic phone calls with mainland lenders, and desperate attempts to calm panicked county officials paint a picture of leadership caught completely off guard by forces they never saw coming. The question isn't just what went wrong in paradise, it's why no one in power seemed prepared for what locals describe as the most devastating housing crash in Hawaiian history. The warning signs were everywhere, but they were buried beneath layers of optimism and political spin that kept the truth hidden until it was too late. Maui's condo boom looked unstoppable through most of 2023. Oceanfront units in Wailea commanded $3 million, while even modest two-bedroom condos in Kihei sold for over $800,000. Buyers from California and the Pacific Northwest flooded the market, many purchasing sight unseen based on virtual tours and glossy marketing brochures. Real estate agents juggled dozens of clients simultaneously, and bidding wars erupted over properties that had been on the market for mere hours. The frenzy reached its peak in early 2024 when a penthouse in the Grand Wailea sold for $12.8 million, setting a new island record. Local news stations ran breathless reports about the boom, featuring interviews with agents who claimed inventory shortages would keep prices climbing indefinitely. Construction crews worked overtime on new luxury developments, while existing condo associations voted to approve massive renovation projects funded by special assessments that owners eagerly accepted, convinced their property values would continue soaring. Governor Green rode the wave of positive headlines, appearing at ribbon-cutting ceremonies for new developments and touting Hawaii's resilience in attracting high-net-worth residents. His administration pointed to record property tax revenues and construction employment as proof that the state's economic strategy was working. Press releases celebrated each new development milestone, while social media feeds showcased smiling families moving into their dream homes against backdrops of pristine beaches and swaying palm trees. Behind the scenes, however, cracks were starting to show. Building departments struggled with permit backlogs as developers rushed to break ground before costs climbed higher. Labor shortages pushed construction timelines from months to years, while material costs doubled and sometimes tripled without warning. Insurance companies quietly began restricting coverage in certain coastal zones, citing increased wildfire and hurricane risks that few buyers fully understood. The state's housing inventory dropped to historic lows by mid-2024. Less than 2 months of supply remained on the market in most desirable areas, creating artificial scarcity that drove prices even higher. First-time local buyers found themselves completely priced out, while long-term residents watched their neighborhoods transform into seasonal playgrounds for wealthy mainlanders. Yet the official narrative remained relentlessly positive, with state economists predicting continued growth well into 2025. What nobody anticipated was how quickly the foundation would crumble once the first domino fell. The turning point came without warning on a humid Tuesday morning in August 2024. Pacific Mutual Insurance, one of Hawaii's largest property insurers, announced they were immediately ceasing all new policies for condominiums built before 1990. The company cited mounting losses from recent wildfire claims and updated risk assessments that made coastal properties uninsurable at current premium levels. Within hours, 3 other major carriers followed suit, leaving thousands of condo owners scrambling for coverage that suddenly didn't exist at any price. The insurance exodus triggered a cascade of mortgage defaults as lenders discovered properties without adequate coverage. Banks froze new loan approvals, while existing borrowers received 30-day notices demanding proof of replacement policies or immediate loan acceleration. Condo associations that had operated for decades with standard coverage found themselves unable to secure master policies, making individual unit sales impossible under most mortgage programs. By September, the crisis had spread beyond insurance into the fundamental mechanics of condo ownership. Special assessments that seemed manageable during the boom years became crushing burdens as property values plummeted. A typical oceanfront building in Kaanapali that required a $50,000 assessment per unit for seawall repairs suddenly faced owner revolts as units worth $2 million in January were appraising for $1.4 million by fall. The psychological shift happened almost overnight. Properties that had generated bidding wars began sitting on the market for months with no offers. Sellers who had expected quick sales at premium prices found themselves cutting asking prices by $200,000, then $400,000, then more, just to generate any interest at all. Real estate agents who had been celebrities during the boom quietly left the business as commission income evaporated and client relationships soured. Local news coverage shifted from celebration to crisis mode. Stories about record sales were replaced by features on foreclosure auctions and families losing their life savings. The same agents who had been quoted predicting endless growth now spoke in hushed tones about market corrections and the need for patience. Construction sites that had buzzed with activity stood partially completed as financing dried up and pre-sale contracts collapsed. Governor Green's office initially tried to downplay the severity of the situation. Press releases spoke of temporary market adjustments and the natural ebb and flow of real estate cycles. Staff members briefed reporters on the state's strong economic fundamentals and pointed to tourism revenue as evidence that Hawaii's appeal remained intact. But behind closed doors, emergency meetings were already underway as the administration grappled with a crisis that threatened to undermine the entire state economy. The real estate collapse wasn't happening in isolation. It was pulling down everything connected to it, from construction jobs to property tax revenues to the confidence of residents who had bet their futures on the promise of endless appreciation. Each falling price became evidence that the dream of Hawaiian paradise might have been built on foundations far less solid than anyone had dared to imagine. As September turned to October, the numbers grew more alarming by the week. Condo inventory had tripled in 60 days, while sales volume dropped by more than half. The median days on market stretched from 2 weeks to 4 months, with many properties receiving no offers despite multiple price reductions. Mortgage applications fell to levels not seen since the 2008 financial crisis, while foreclosure filings began appearing in neighborhoods that had never experienced distressed sales. The stage was set for what would become one of the most dramatic political responses in Hawaiian history, as pressure mounted on Governor Green to acknowledge what everyone could already see. The first cracks in Governor Green's carefully maintained optimism appeared during a routine budget meeting on October 15th. County officials from Maui had requested an emergency session to discuss plummeting property tax revenues, but what they found was an administration still clinging to talking points from the boom era. When Maui County Finance Director Sarah Nakamura presented data showing a projected 40% drop in property tax collections, Green's initial response was to question the methodology rather than address the implications. Internal emails obtained through Freedom of Information requests revealed the mounting frustration within the governor's inner circle. Chief of Staff Michael Torres wrote to senior advisors that the administration was facing a credibility crisis as media outlets began comparing official statements to observable market conditions. One particularly damaging email exchange shows Torres warning that continued denial would make the eventual acknowledgement far more politically costly. The pressure intensified when 3 major mainland lenders announced they were suspending all new mortgage originations for Hawaiian condominiums pending a comprehensive market review. Wells Fargo, Chase, and Bank of America cited volatile market conditions and inadequate insurance availability as primary factors in their decision. The lending freeze effectively shut down the remaining sales activity, trapping sellers who had already reduced prices multiple times with no viable exit strategy. Local real estate professionals began organizing informal meetings to discuss coordinated responses to what they privately called the administration's head in the sand approach. Veteran agents who had weathered previous market downturns expressed concern that political messaging was making recovery more difficult by preventing realistic price discovery. Some threatened to publicly break ranks if the governor continued minimizing the crisis scope. The breaking point came when the Maui Association of Realtors released internal market data showing that 90% of pending condo sales had fallen through in the previous 30 days. The report, which had been scheduled for routine quarterly release, instead became front-page news across Hawaiian media outlets. Local television stations led evening broadcasts with images of empty condo developments and interviews with distraught homeowners facing foreclosure. Within hours of the report's release, Governor Green's office was flooded with calls from mainland media outlets seeking comment on what national publications were already calling Hawaii's housing apocalypse. The Wall Street Journal ran a feature story comparing Maui's market collapse to previous bubble bursts in Las Vegas and Phoenix, while CNN aired segments showing abandoned construction projects and desperate sellers. The political ramifications were immediate and severe. Republican opposition leaders called for emergency legislative sessions to address the crisis, while some Democrats within Green's own party began distancing themselves from the administration's handling of the situation. Tourism industry representatives expressed concerns that negative housing market coverage could damage Hawaii's broader economic image. On October 28th, leaked audio from a closed-door meeting revealed Green's growing frustration with his staff's inability to control the narrative. In the recording, the governor can be heard asking advisors why they hadn't anticipated the insurance industry's coordinated withdrawal and questioning whether anyone in his administration actually understood real estate market dynamics. The audio, which surfaced on local radio stations, showed a leader grappling with events that had spiraled far beyond his team's expertise. The situation deteriorated further when Standard & Poor's announced they were reviewing Hawaii's credit rating due to concerns about declining property tax revenues and potential municipal budget shortfalls. The credit review triggered selling pressure on state bonds, while municipal financing for infrastructure projects faced immediate delays as lenders reassessed Hawaiian market risk. County officials on Maui began openly contradicting state messaging, with Mayor Richard Bisson holding press conferences to provide realistic market assessments that directly challenged Green's optimistic projections. Bison's straightforward acknowledgement of the crisis won praise from local residents while highlighting the disconnect between state and county leadership approaches. The governor's isolation became apparent when key Democratic allies in the legislature began calling for transparency and accountability in addressing the housing market collapse. State Senator Donna Kim publicly questioned whether the administration had been receiving accurate briefings about market conditions, while Representative Mark Nakashima demanded full disclosure of any early warning signs that might have been ignored. As November approached, Green faced mounting pressure from multiple directions. Homeowner advocacy groups organized protests outside the state capitol, while real estate industry leaders demanded immediate action to restore market confidence. federal officials began inquiring about potential systemic risks to Hawaiian banks with heavy condo loan exposure, raising the specter of broader financial institution problems. The confluence of political, economic, and social pressures created an unsustainable situation for an administration that had built its reputation on competent crisis management. Each day brought new evidence of the market's continued deterioration, while Green's team struggled to develop responses that acknowledged reality without triggering additional panic selling. By early November, internal polling showed the governor's approval ratings had fallen to their lowest levels since taking office. The housing crisis had evolved from an economic issue into a test of political leadership, with voters increasingly questioning whether their elected officials understood the magnitude of challenges facing ordinary Hawaiian families. The stage was set for a dramatic confrontation between political spin and market reality, with Governor Green's credibility hanging in the balance as pressure mounted for a comprehensive response to what had become an undeniable disaster. The moment of reckoning arrived on November 18th, when a confidential briefing document surfaced showing the governor's economic team had identified warning signs as early as March 2024. The 23-page report, stamped internal use only, detailed insurance industry concerns, rising construction costs, and buyer sentiment shifts that suggested the market was entering dangerous territory. The document's recommendations included proactive measures to address insurance availability and transparent communication about market risks. What made the leak particularly damaging was evidence that Green's team had chosen to suppress the report's findings rather than act on them. Email threads revealed heated debates between economic advisors who wanted to issue public warnings and political staff who feared any negative messaging would accelerate market decline. The decision to prioritize short-term political considerations over long-term economic stability would prove to be a catastrophic miscalculation. The political firestorm intensified when investigative reporters discovered that several administration officials had quietly sold their own Hawaiian properties in the spring of 2024, months before the public received any indication of potential market problems. Deputy Director of Economic Development James Liu had sold his Kihei condo for $2.1 million in April, while Communications Director Rachel Wong disposed of her Whaley unit for $1.8 million just weeks after the internal warning report was completed. These revelations transformed public anger from disappointment to outrage. Residents who had watched their life savings evaporate while officials privately protected their own investments demanded immediate accountability. Social media exploded with calls for resignations, while local news stations ran nightly segments tracking the property transactions of government employees during the critical spring period. The governor's inner circle began fragmenting under the pressure. Senior advisors who had been loyal allies started distancing themselves from the administration's response strategy, with some leaking additional damaging information to protect their own reputations. The cohesive that had characterized messaging Operation Green's first term dissolved into finger-pointing and blame-shifting, as each revelation made the previous explanations look more inadequate. Federal attention arrived in the form of Securities and Exchange Commission investigators examining whether state officials had engaged in insider trading by using non-public market intelligence to time their personal property sales. The investigation sent shockwaves through Honolulu's political establishment, as dozens of current and former officials faced scrutiny over their real estate transactions during the crucial warning period. Banking regulators also launched inquiries into Hawaiian financial institutions with significant condo loan portfolios. First Hawaiian Bank, which had aggressively pursued condo lending during the boom years, faced particular scrutiny as regulators questioned whether loan underwriting standards had been adequate for such a volatile market. The bank's stock price fell 23% in a single trading session following news of the regulatory review. Local credit unions that had marketed themselves as community-focused alternatives to mainland banks discovered they were equally vulnerable to the condo market collapse. Hawaii State Federal Credit Union reported that nearly 40% of their mortgage portfolio consisted of condo loans, with many borrowers now owing significantly more than their properties were worth. Member services representatives fielded hundreds of calls daily from desperate borrowers seeking loan modifications or forbearance agreements. The ripple effects extended far beyond real estate into Hawaii's broader economy. Construction companies that had expanded rapidly during the boom found themselves with massive overhead costs and no new projects to fund ongoing operations. Island Pacific Construction, once the state's largest condo developer, laid off 60% of its workforce and filed for Chapter 11 bankruptcy protection as pre-sale contracts collapsed and financing evaporated. Tourism industry leaders worried that negative publicity surrounding the housing crisis would discourage visitors from booking Hawaiian vacations. Hotel occupancy rates in Maui began showing subtle declines as mainland media coverage portrayed the island as economically unstable. Resort operators pressed the governor's office for positive messaging to counteract growing perceptions that Hawaiian paradise was in decline. The crisis deepened when Moody's Investor Service downgraded Hawaii's credit outlook from stable to negative, citing declining property tax revenues and potential municipal budget shortfalls. The downgrade increased borrowing costs for state and local governments, just as they faced growing demands for social services from displaced homeowners and unemployed construction workers. Small businesses throughout Maui reported dramatic revenue declines as former homeowners either left the island or drastically reduced spending. Restaurants that had thrived serving wealthy condo owners saw customer counts drop by half, while luxury retailers faced inventory they couldn't move as their target demographic disappeared. The economic contraction created a feedback loop that accelerated the housing market's decline. Educational institutions felt the impact as families with school-aged children relocated to more affordable markets on the mainland. Maui's private schools, which had expanded facilities during the boom to serve affluent newcomers, faced enrollment drops that threatened their financial viability. Public schools in upscale districts saw similar patterns as families either moved away or transferred children to less expensive alternatives. Healthcare systems struggled with the dual challenge of serving residents who had lost insurance coverage while facing reduced demand for elective services, as discretionary income evaporated. Maui Memorial Medical Center reported increasing numbers of uninsured patients seeking emergency care, while specialists who had built practices serving wealthy retirees saw appointment volumes plummet. The social fabric of island communities began showing strain as economic stress translated into personal hardship. Suicide prevention hotlines reported increased call volumes, while domestic violence organizations documented rising incident rates. Food banks experienced unprecedented demand from middle-class families who had never previously required assistance but found themselves unable to afford basic necessities after losing their homes. Community organizations that had relied on donations from affluent residents faced their own financial crises as their donor base disappeared. The Maui Arts and Cultural Center canceled programming due to funding shortfalls, while environmental groups suspended conservation projects as grant funding dried up and individual contributions vanished. Real estate professionals who had built careers during the boom years faced professional extinction as transaction volumes collapsed. Many agents who had earned six-figure incomes found themselves competing for the handful of remaining sales, while others left the industry entirely to pursue more stable employment. The Hawaii Association of Realtors reported that membership had declined by 35% since the market peak. Property management companies that had overseen vacation rental portfolios discovered their services were no longer needed as owners either sold at massive losses or simply walked away from underwater properties. Maintenance contractors, landscaping services, and cleaning companies that had built businesses serving the luxury condo market faced immediate revenue force declines that widespread layoffs. As December approached, the accumulating evidence of systemic failure created an unsustainable political environment for Governor Green. Every economic indicator pointed toward deeper problems ahead, while his administration's credibility had been shattered by revelations of insider knowledge and personal profiteering. The pressure for a comprehensive public response reached levels that could no longer be ignored through political maneuvering or carefully crafted statements. The stage was set for what would become one of the most consequential press conferences in Hawaiian political history, as Green faced the impossible task of explaining years of denial while proposing solutions to a crisis that had metastasized far beyond the housing market into a broader threat to the state's economic foundation. The emergency press conference, scheduled for December 3rd, became the most anticipated political event in recent Hawaiian memory. Governor Green's staff spent 72 hours crafting what they hoped would be a definitive response to months of mounting criticism. Internal documents show multiple drafts were prepared, ranging from defiant justifications to complete mea culpas, as advisors debated whether to minimize the crisis or acknowledge its full scope. Behind the scenes, the governor's team faced impossible political mathematics. Polling data revealed that 67% of Hawaiian voters blamed the administration for failing to prevent the housing collapse, while 73% believed officials had prioritized their own financial interests over public welfare. Focus groups conducted by Democratic strategists found that even loyal party supporters were struggling to defend Green's handling of the situation. The morning of the press conference brought fresh complications when the Honolulu Star-Advertiser published leaked audio recordings from internal administration meetings. The recordings captured heated arguments between Green and his economic advisors, with the governor expressing frustration at being blindsided by market developments that he claimed no one could have predicted. More damaging were comments suggesting that housing affordability had never been a priority for an administration focused on attracting wealthy mainland residents. Television crews from mainland networks descended on Honolulu, transforming what might have been a routine local news event into national political theater. CNN, Fox Business, and CNBC all sent correspondents to cover what they framed as a cautionary tale about state-level economic mismanagement. The national attention added pressure on Green to deliver substantive policy responses, rather than the political deflection that had characterized previous statements. Minutes before facing the cameras, Green received word that 2 more major insurance companies had announced their withdrawal from Hawaiian markets. Allstate and State Farm cited continuing volatility and regulatory uncertainty as factors in their decisions to cease writing new policies for residential properties. The timing couldn't have been worse, providing fresh evidence that the crisis was deepening rather than stabilizing. The press conference began with Green appearing visibly strained as he approached the podium. Gone was the confident demeanor that had characterized his previous public appearances during the housing boom. Instead, cameras captured a leader grappling with the weight of decisions that had contributed to widespread economic devastation. His opening statement, which ran nearly 12 minutes, attempted to balance acknowledgement of problems with defense of his administration's overall record. Green scored on external message center factors beyond state control, including federal monetary policy, insurance industry consolidation, and mainland economic pressures that had distorted Hawaiian markets. He pointed to similar housing challenges in California and Florida as evidence that Hawaii's problems reflected broader national trends rather than local policy failures. The governor emphasized his administration's commitment to working with federal partners and private sector leaders to develop comprehensive solutions. However, the press conference quickly devolved into confrontational exchanges when reporters pressed for specific accountability measures. When asked directly whether he would accept responsibility for the leaked internal report that warned of market instability, Green deflected by questioning the motives of whoever had violated confidentiality protocols. His refusal to address the substance of the warnings while criticizing their disclosure struck many observers as tone-deaf given the magnitude of ongoing hardships. The evidence now speaks for itself. Hawaii's condo market collapse erased billions in property values, while Governor Green's administration ignored warning signs and prioritized political messaging over economic reality. Internal documents reveal officials sold their own properties months before acknowledging the crisis publicly, leaving thousands of residents trapped in underwater mortgages and vanishing insurance coverage. The fallout extends far beyond real estate into banking, tourism, and the broader Hawaiian economy. As federal investigations continue and recovery timelines remain uncertain, one question lingers for residents still fighting to save their homes and their dreams of island paradise. Will accountability finally arrive? Or will the true costs of this disaster remain buried deep beneath political spin and careful public relations?